let's dive right into this explainer, functioning essentially as an anonymous expert report to analytically deconstruct a hidden mechanism in the tax code. We're talking about something that quietly, almost invisibly, drains capital from independent workers and business owners, the self-employment tax. Now, we aren't going to waste time on surface-level definitions today. Instead, we're going to uncover exactly how default tax exposures mathematically deplete your capital, and honestly, more importantly, how specific structural interventions can completely alter those very mechanics. If you're looking to understand the exact mathematical pathology of your tax burden and how to architect a real viable solution, well, you're absolutely in the right place.
Here's our logical framework for today's analysis. We're going to systematically break down the simplicity trap, deconstruct the mechanics of the self-employment tax, map out the compound tax burden, look at structural intervention strategies, and finally, analyze the bifurcation of business income.
Starting with part 1, the simplicity trap, and the baseline condition of default structures.
Expert analyses point to a massive systemic misconception right out of the gate here. People naturally assume that because a sole proprietorship is so easy to set up, requiring no special registrations, no complex corporate filings, no formal payroll systems, that it must be the most efficient way to operate, right? Well, this is exactly what we call the simplicity trap. It turns out the IRS doesn't hand out gold stars for saving them paperwork. In reality, default administrative simplicity directly correlates with maximum tax liability. It also comes with statistically higher audit risks. Fast, free, and familiar literally equates to the highest possible default tax exposure. The system heavily penalizes a lack of structural architecture.
So, the absolutely crucial point here is understanding this baseline mechanism. In a traditional corporate employment scenario, the tax burden is legally shared between two distinct entities, the business itself and the worker. But when you operate in this default state, the tax code essentially initiates a structural collapse. The entity and the individual are treated as the exact same economic unit. You are the employee earning the money, and you are simultaneously the employer paying the money. This complete collapse of distinct roles is the precise legal trigger for the specific tax liability we are about to analyze.
Moving on to part 2, self-employment tax mechanics and what experts identify as its mathematical pathology. The self-employment tax is frequently misunderstood. A lot of folks think it's just some arbitrary penalty for having the guts to work for yourself. Actually, scratch that. It's not arbitrary at all. It is a highly specific mechanical replacement for traditional W-2 payroll withholding. Think about a standard W-2 job. The employee pays 7.65% of their paycheck towards Social Security and Medicare, and the employer legally matches that exact 7.65%. But because the default pass-through structure makes you both the employer and the employee, the IRS legally obligates you to fund both halves. You carry the entire 15.3% burden entirely by yourself. It's a direct mathematical consequence based 100% on your lack of corporate structure. Breaking down this 15.3% levy reveals its core operational components. We're looking at 12.4% directly allocated to Social Security and 2.9% going to Medicare. It is so essential to recognize that this acts as a flat, regressive bite straight out of your early profits. I mean, it hits $1. Now, the Social Security portion does eventually cap out once you hit a certain high income threshold set by the IRS every year. However, that 2.9% Medicare portion, that never stops. It continues indefinitely, applied to every single dollar of net profit generated within this default structure, forever scaling right alongside your success.
Diving a little deeper into the mechanics, financial analyses reveal a totally non-obvious but absolutely vital detail. This 15.3% tax is strictly applied to exactly 92.35% of your net business earnings, not 100% of the gross revenue. So why this incredibly specific number? Well, it's a built-in mathematical adjustment by the IRS to simulate the deduction a standard employer gets for paying their half of the payroll taxes. Essentially,
It levels the playing field just a tiny fraction by reducing your taxable base by 7.65%. While this slight adjustment prevents you from being taxed on the tax itself, it absolutely doesn't change the fundamental reality. A massive percentage of your hard-earned profit is still being subjected to this specific levy.
Furthermore, experts note a progressive penalty secretly built into the mechanism. There's an additional 0.9% Medicare surtax that gets triggered automatically for high-income earners once specific profit thresholds are breached. This fundamentally alters the equation. What it means is that as your default structure scales in revenue, the mathematical pathology actually worsens. Your entrepreneurial success is actively penalized by an escalating percentage rate, proving once again that staying in that simplicity trap becomes a more and more severe financial liability the larger your business grows.
Let's transition to part 3, the compound tax burden and the infamous double hit effect.
If we walk through the actual math step by step, it perfectly proves this compounding double hit effect. The cause and effect relationship here is pretty brutal. First, your net profit is subjected to that hefty 15.3% levy we just mapped out. Then, that very same profit is pushed straight into your standard federal income tax brackets and potentially state income tax brackets too, depending on where you live. It is a compounding extraction that can seamlessly consume 30%, 40%, or even nearly half of your total generated capital. Financial analysts often refer to this as the tax treadmill. It creates an environment where it becomes mathematically incredibly difficult to retain enough capital to effectively reinvest, hire, and scale your operations. You're constantly running just to hand your margins over.
Part 4. Structural Intervention Strategies and the S-Corporation Election. Okay, so we've diagnosed the mathematical pathology. Now it's time to look at the structural cure. Reports consistently indicate that once net profits exceed approximately $50,000, the S-Corporation election becomes a highly strategic intervention to completely bypass the simplicity trap. And let's be absolutely clear, this is not a loophole, and it's certainly not a tax evasion tactic. It is a deliberate architectural choice formally recognized by the tax code. By making this specific tax election, you fundamentally change how the IRS views the relationship between you and your business entity. You are no longer treated as a single, collapsed economic unit. Instead, the structure introduces a legal barrier that totally rewrites the mathematical rules of how your income is classified and subsequently taxed. And finally, Part 5, bifurcation of business income, which is how we alter the tax calculation. The core actionable insight here is a concept called bifurcation. By splitting your net profit into two distinct streams, a reasonable salary on one hand and owner distributions on the other, the mathematical exposure to that 15.3% tax is drastically reduced. Under the S-Corporation structure, you legally become an employee of your own entity. You must pay yourself a reasonable salary based on objective industry standards for the actual work you perform. That salary is absolutely subject to the 15.3% payroll tax. However, here is the mechanical shield. Whatever profit remains in the business after that salary is paid out is taken as an owner distribution. And that distribution is legally entirely exempt from the 15.3% self-employment tax. You've successfully isolated the pathology to just your base salary. It's brilliant.
Let's actually run the numbers in a side-by-side scenario to mathematically prove how this intervention isolates liability and retains your capital. Look at the modeling here. At exactly $100,000 in net profit, the default sole proprietorship subjects almost the entire amount to the 15.3% tax. The result? Over $14,000 paid strictly to this one specific tax, and that's before federal and state income taxes even begin. But the S-Corporation bifurcates that income. If a defensible, reasonable salary is set at $30,000, only that $30K is subjected to the 15.3% tax. The remaining $70,000 flows directly to the owner as a distribution, completely bypassing the 15.3% burden. The mechanics of structural arbitrage here save almost $10,000 in a single operating year.
That is pure retained capital going straight back onto your balance sheet. Now, to maintain absolute analytical objectivity, we really have to look at the other side of the ledger. This structural intervention is not free. It requires an ongoing maintenance cost of roughly $3,000 to $4,000 annually. You have to pay state franchise fees, hire professionals for the more complex dual entity tax returns, and run a compliant payroll software infrastructure. This is exactly why that $50,000 net profit threshold we mentioned earlier is so critical. If your business is only making $20,000 in profit, the $4,000 in maintenance costs will completely wipe out any self-employment tax savings you might have generated. It's a strict analytical balancing act of operational cost versus mathematical yield.
So, as we wrap up this explainer, ask yourself, are you evaluating your business structure with the exact same mathematical rigor you apply to your revenue generation? The mechanics of the self-employment tax clearly demonstrate that allowing your business to default into the simplicity trap is a direct cause of unnecessary compounding capital depletion. By understanding these deep mathematical mechanisms and actually utilizing the power of structural bifurcation, you can completely optimize your financial architecture. So understand the mechanics, optimize your legal structure, and stop paying a massive premium just for simplicity.